it's the raft of new regulations that still proves to be a challenge for this industry. But we do need them. If anything, it's what the global financial crisis has taught us. So why exactly are they being viewed more as a hindrance as opposed to aid or risk mitigator?
The first thing is it's the significant cost that's involved in implementing some of these changes, particularly in areas like Solvency II, which in South Africa we call SAM, or Solvency Assessment and Management. Figures that are being bandied around in Europe are to the order of 40 billion rand, dollars or euros, for implementation across Europe. When you look at SA, that figure is still unknown, but it could run to anything up to 1 billion rand for the bigger insurers. So it's the burden of the costs as well as the human resources and talent that required to implement these changes. So yes, it's good that we have these changes, but there are difficulties and costs involved.
Of course, where this is being highlighted, one has to ask the question then what the risk management techniques or risk management strength is of the insurance sector without, onerous regulation coming to the fore.
I think what the financial crisis has taught the industry is specifically that improvements in risk management. We have seen a strengthening of risk management in general, but regulations, particularly around Solvency II, are not just concerned about risk management. They are concerned about capital and the levels at which insurers and financial institutions hold that capital. There's a sense globally that those capital requirements could increase, which is more expensive for financial institutions. And in South Africa, we might have a view that the companies are well capitalized, but there is also uncertainty around whether there will be more capital requirements.
Yeah. Of course, those capital requirements are coming to be bear at a time where we've seen a strong riser in this year's ranking of 26 risks, and that the incidence of natural catastrophes. Were you surprised at the way that has elevated up the ranks?
It wasn't surprising when you consider what happened in New Zealand and Japan. So that's, I would say, is a natural reaction to those realities unfolding. And then there's also a realization that the frequency of occurrence of those natural catastrophes is much more pronounced now. And also a need to re-look at insurance cover in those areas. So not a surprise, but a lot of work going into readjusting portfolios and re-rating of premiums.
Of course, that readjustment of portfolios happening in a context where we've got a combination of an economic recession, low interest rate, sovereign debt fears in the Eurozone, also cutting investment returns. So how's the sector viewing the operating or that macro context right now?
The macroeconomic trends make it very difficult for insurers, particularly the non-life side. When you look at the catastrophe claims and the significance of that cutting into underwriting profits, then it's imperative that you then have very good investment returns. It doesn't help that we've got low interest rates, inflation, resurgent inflation, worsening the investment performance environment. So where insurers would have been subsidized by investment performance, this time around there's nowhere to look to.
Of course, when it comes to growth, then we're going to have to look at being a little bit more competitive, players coming through with a little bit more aggression in that regard. What kind of competitive environment are we looking at?
It's very competitive. For the life sector, growth is essential to increase life policy portfolios. If life insurers don't increase their portfolios, then basically they die or they go into negative territory. So growth is very important for them. It's very difficult. What makes it more difficult is the expense involved in distribution, particularly on the retail side, where you have to employ foot soldiers, if I may call them, to distribute products, particularly in countries like SA, where we've got large rural populations. If you look on the non-life side, there's a sense that there's excess capacity in the marketplace, which in itself pushes premium rates down and essentially is it's got negative consequences for growth. But there are also other opportunities for companies in South Africa, going north into Africa, where the insurance penetration rates are very low relative to South Africa and the rest of the world. We've seen the resurgence in re-looking at bank assurance models, new joint venture arrangements, new tie-ups with other insurers in other countries, basically to try and get that growth. And then also the use of technology, like cell phone distribution and so on, which hopefully should bring down costs.
What about the use of simplicity? Because in this drive to gaining market share, what kind of strides are being made in something that consumers have highlighted about insurers specifically, that the policies use exclusionary language, there's poor policy wordings and insufficient transparency. What kind of strides are being seen in that regard?
Two things are happening, particularly on the regulatory front. We've got in the UK a retail redistribution review, which specifically looks at retail sales practices in that environment, and really forcing insurers to treat customers fairly. If you come back to South Africa, we've got a specific project, which is the FSB have launched, and specifically targeted treating customers fairly. So there is a lot happening on the regulatory front. And then the insurance industry itself, really looking at their reputational risks. And you see reputation hasn't gone away from the list. So there's a sense that insurers need to look at reputational risks as well.
Of course, regulatory burdens and red tape, those are issues that aren't going to go away anytime soon. How do insurance players use this to their competitive advantage?
I think regulation is something everybody has to embrace, whether the insurers or bankers or anybody operating in an industry where they deal with the public. Regulation is here to stay, particularly when you look at what's happened with the financial crisis. The public has to be protected and so on. So there's a sense that they need to embrace it, work with it, and then do whatever they do to get it done quickly and take advantage of growth strategies.